Good morning, good evening, good afternoon, depending on which part of the globe you're at. This is Payment System Broadcast Session 18. We're going to allow the people to enter the room and we're going to start shortly. Thank you for joining. Good, I think that we can start already. So once again, thank you everyone for joining the Payment System Broadcast, our session 18. The title of today is The Future of Money and Payments, in which we're going to discuss how to balance innovation, regulation, and resilience. As usual, the housekeeping is going to be just limited to these 5 minutes that I'm going to talk a lot and alone. Then we're going to have to start our main session. And today we had a very short notice change of plans. We were going to have Matthew Hunt, we're going to have Matthew Hunt, which is the strategic advisor for Deloitte and MasterCard and currency research chair for Global Payment Summits, who is a visionary and industry leader with deep expertise in payment system operations. And we were going to have Hamish Thomas, who is a Deloitte partner and payments and future money lead, who could not join us today, but he was kind enough to introduce us to Gallo, who is Deloitte Europe, Middle East, and Africa Payments and Innovation Lead at the Center for Regulatory Strategy, and Ben Thornhill, which is Deloitte Europe, Middle East, and Africa Center for Regulation and Strategy Manager. So thank you, Matthew, thank you, Val, and Ben, for joining us today.
Lovely to be here.
Yeah, good to be here.
Thanks, Carlos.
That's great. So the idea for today is that we're going to explore, as our title says, we're going to explore things related to how to balance innovation, regulation, and resilience of payment systems, and how we're seeing the future of money and payments as well. So I think that we can start with your introductions. Each one of you can introduce yourselves briefly. And if you want to include some kind of disclaimer, perhaps this is the best moment to do it. So ladies first, Val.
Well, thank you so much. So I'm Valeria Gallo, but I go by Val. As you said, Carlos, I am the Innovation and Payments Lead in the EMEA Center for Regulatory Strategy at Deloitte. And our team is really a bit of a think tank within Deloitte, and what we do is looking at, upcoming regulatory change and trying to understand what that means for innovative business models, for adoption of new technology, and sort of develop the point of view of what Deloitte thinks about these issues. And we work very, very closely with Matthew and Hamish on all things payments and innovation. So that's my portfolio, and I work very closely with Ben, who's going to introduce himself in a second, but he's our digital asset guru. So Ben, maybe over to you for a moment.
Yeah, I'll jump in now. So hi everyone, good to be with you. So I'm Ben Thornhill, like Val says, part of the EMEA Center for Regulatory Strategy at Deloitte, and I lead our team's work around digital assets. And then Val and I work closely on all things payment. So really advising clients on some of the strategic opportunities and challenges posed by the ever-changing regulatory landscape. Matthew, over to you.
Thanks, Ben. And thank you, as Carlos said, Ben and Val, for standing in for Hamish at the last minute. Hamish is such a loss to us. We had to replace him with two of you, not just one. But as Carlos said, I'm Matthew Hunt. Carlos introduced what I do now, which is a range of roles in the payments industry. I will just embarrass Ben and Val a little bit, though, by saying since I've been working with Deloitte, I've really enjoyed working with their team, the European Centre for Regulatory Strategy, which I hope I got right this time, Val, after you corrected me on getting the name wrong earlier this morning. I think it's a really valuable resource to have that deep analytical policy function to help us build our own market intelligence and eminence around the world of payments. And I've certainly learned a hell of a lot about digital assets and how the digital payment market is likely to evolve through working with the ECRS team since I've been at Deloitte, and I hope we can share that with some of you today. Just to complete this rather rambling introduction, before doing the advisory work I do now, I was the deputy CEO at a company called Pay.UK for 4.5 years that runs the interbank payment infrastructure in the UK. And before that, I did various operational payments roles at the Bank of England, even banknotes. So I've been in charge of banknotes, gold vaults, and running the RTGS payment system and government banking. So I hope to draw on all that experience in my remarks today. And thank you to Carlos and FNA for having us.
Thank you all for this. I'm going to go back a little bit just to remind the public that all the questions and answers, they can submit it in the Q&A widget, which is in WebEx. It's already in WebEx. So any question that you have, perhaps send them there, and we're going to consider them at the end of the meeting, because the last 10 to 15 minutes, we're going to devote the time to answering or to addressing those questions from the public. So I think that we have the introduction, so let's start. One of the things that I liked when I entered and I was preparing the contents of this broadcast is I entered the Deloitte's Future of Money website, which is a very interesting one. It has several documents which are very interesting. Is that you start with a phrase that I like a lot, because for anyone to start learning about something, you have to confess and you have to realize that you don't know much, at least. So there's this phrase or this question that says in the website, what does the future of money look like? It's a question, and the answer is the truth, no one knows. So I'm going to ask you to tell me or to tell the public, what are your perspectives on the major forces driving change in the payments industry today? We don't know where we're going, but I think we know what is driving change now. I don't know who wants to start. Ladies first, once again.
Oh no, I'm going to delegate to Matthew on this one first.
I always do what I'm told, so I'll go. I mean, thank you for the way you introduced that, Carlos. And of course, the first thing to say is we didn't know 2 years ago when we published it, and we still don't know now. But it's funny, when I was involved in that, when we published it, I think it's nearly 2 years ago now. It was one of the first things I did when I arrived at Deloitte. And I thought, in 2 years' time, we'll know all this. It'll all be clear. And of course, it still isn't. The future is by definition always somewhat unknown. But we have learned a hell of a lot about the market dynamics in the 2 years since we published. So I actually thought I would focus this answer on what's emerged since, because I think quite a lot has. So if I take CBDCs as the first, big dynamic, that was heavily talked about, and certainly, the evolution of digital assets and CBDCs was a really major theme in the Future Money program, as those who will read the website can say. And I think some really important things have happened in the intervening period. So the Eurozone is pressing on and delivering a retail CBDC program, and they've published their reasons for doing so. And I think this is a really fascinating piece of work, because they are, amongst some of the major Western economies, one of the first movers in a retail CBDC program, whereas many other economies are focusing at the moment on wholesale CBDCs and how CBDCs can interact with RTGS systems and so on. So I think the Eurozone innovation is one. Closer to home, and because they are my former employer, I should also talk about a couple of Bank of England publications that I think give us more clues on how the future of money might evolve. I will draw on a couple of things. So one, in a discussion paper in July, the Bank of England published its policy outcomes for retail payments I think it was a late July discussion paper. And I think there's some real clues there about how policymakers want to drive this market. Those 4 outcomes were singleness of money. So making sure that a pound to use the UK currency, in whatever form, whether it's digital, a bank account, a banknote, or whatever, is always worth £1, and there's no arbitrage in value. They talked about innovation, and I think how digital assets and the technology that underlies digital assets, I'll come back to that, can drive innovation is a really important thing too. Whenever the bank talks about payments, it talks about resilience. Payment systems have to work. There's no point building a world-leading digital asset payment system if it falls over all the time. And they also talked about governance and funding, which I think, whilst not the most fashionable area of payments, really matters. Who funds payment systems, who pays for innovation, who is in charge of the strategic decisions they make. These are all very relevant issues around the future of money too. The other thing I would draw on, and I'll stop in a minute, that the bank has talked about, Andrew Bailey delivered a speech. It was just before the Mansion House speech in Washington about a month and a half ago now, where he talked very clearly about the role of tokenized deposits. And I think this is one of the major messages I want to deliver in this webinar, that certainly in the UK, the conversation, I think it has started to become a bit less about retail CBDC and a bit more about tokenized deposits and how assets that we're used to, because a lot of us have bank balances that are already in the banking system, can be put on a digital ledger, and how we can still benefit from the digital ledger technology whilst perhaps using a more traditional financial instrument. So I think there's a lot to be taken from that speech, and I will certainly be thinking a lot about the role of tokenized deposits going forward as well. And my final point, I think at this stage, when looking at the future of money, I think it's always helpful to draw a distinction between the instrument itself, whatever it is, whether it's Bitcoin, a retail CBDC or whatever, and the technology that underlies it. Because quite often, even if the instrument has limited use cases, the technology that underlies it might have some really interesting use cases, and that can make things really take off. So I'm sure I will return to those themes later in the webinar, but I will stop and hand over to Val.
Yes, that's fascinating, Matthew, and I totally agree with you. I think the only thing that I would add to that, and maybe that's, there's some elements around the future of money that are less academic, less policy, less rational, which is the concept of trust. At the end of the day, money is a social contract. And so you need to have that trust in that social contract. And I think because of the balance between money backed by central banks and government money, new forms of private money, and, maybe after the financial crisis, trust in banks, institutions, or private in large, more trust in other forms of private enterprise, whether it's big techs or others. I think we are all asking ourselves, where do we want to place our trust? Who do we trust? Where is the right balance? What are the safeguards that need to be put in place for that trust to, trust but verify sort of thing, and so there's a lot of debate. So that's, I think, one of the reasons why we don't know what the future of money looks like, finally, because there's also that emotional, more irrational components of trust and social contract that is developing. And it's good that it takes time because there needs to be a public discussion about it.
Yeah, great. I would add something, and I think that Matthew touched several. One point that I like a lot, which is there is money, you mentioned the payment instrument, and there's the technology, and those two things are interrelated, but they're not the same. And Val, you just mentioned trust. I would add something, which is money. So I would say that perhaps the conversation is an entangled thing about these four concepts. What is money, or what we consider money, what we can consider payment instruments, because not all payment instruments are money, or not money are payment instruments as well, and also the technology and the trust. So I think that any conversation about retail payments have to go or to touch some way, somehow, these 4 points. And that's a very nice thing to start our conversation with. So that's a good thing.
If I could just jump in and add one point as well, and I agree with everything Matthew and Val have said. I think the other interesting theme for me at the moment is around wholesale and payment innovation as well. So Matthew, you touched on all of the work the Bank of England's doing at the moment and the paper it published over the summer. And one of the key themes in that is looking at the future of wholesale settlement. And one of the exciting things in the UK we're expecting next year is the Bank of England to launch new wholesale central bank digital currency pilots. So it's interesting, I think, to see the conversation around retail, that will persist, retail CBDCs, tokenized bank deposits. But I think there's an increasing focus around wholesale payment innovation as well. So that's something which I think is interesting, looking into the future.
And sorry to all keep jumping in, but I think these things always work better as a conversation. I just, when Val made her point about trust, it brought back a memory actually from 2006 when I joined the Bank of England, in a banknotes role, and the really strategic concepts about payments, and trust is obviously one of them. You kind of find they've endured over a very long period. And on my first day at the bank, someone I worked with, because it was banknotes, had a book on their desk about the history of banknotes called Promises to Pay. And of course, the phrase is very relevant there, promise to pay, because promise to pay has a huge underlying theme of trust. So I just wanted to hammer home that point that, trust is not new. Ever since banknotes first existed, and let's not try and answer the profound question now of what money is, otherwise we'll be here all day. But ever since banknotes first existed and we talked about what is money, trust has been an enduring theme. So I think Val is absolutely right to raise that. That's
true. Now that we're talking about how the money, technology, payment instruments, and trust have evolved, perhaps a good question to ask is how can the regulators and supervisors balance innovation and stability in the payments ecosystem, in which I will highlight once again that we should be taking into account what is money, what is technology, what is trust, and what are payment instruments. So how can regulators and supervisors balance innovation and stability in this ever-changing payment ecosystem?
Maybe I can start with this, and then I'm sure that Matthew and Ben will add because to it, because definitely not one person can answer this question. But I think that question is very much at the forefront of the new governments and regulators at the moment. I think many people that are listening here, and definitely all of us on the call, would have very much dug deep into the national payments vision that was released in November on the 14th, when the Chancellor made her speech at the Mansion House. And really that was the leitmotif, right? How do we make sure that obviously we maintain stability, that we have sufficient safeguards to ensure that consumers are adequately protected and markets are, market integrity is protected, but also how do we support innovation, both in terms of technology and business model, to make sure that we grow and we innovate, but not for growth and innovation's sake, because growth and innovation are, the means for empowering all stakeholders to give consumers more of a financial capability, to increase inclusions, to give more choice and better experiences to everybody. So I think that's very much very key questions. And I think what is slightly shifting is increasingly the debate is about the cost of the inaction. So what is the cost of not doing something in order to support that innovation, and realizing that actually maintaining the status quo is not, you can't maintain the status quo. Innovation happens, things change, and you can't just maintain the status quo. And actually trying to do that is actually more detrimental than actually allowing and supporting a degree of thoughtful risk taking in adopting new technology or new business models. And so I think we are definitely, the government is certainly pushing for it. And I think the regulators, obviously they have a tough job of balancing everything. But I think, Matthew, very keen to also hear your views, but I think there is a change in stance here to say, actually, we are much more open to hearing, what we can do to support that, because we are realizing the cost of inaction is actually getting quite high. So, the key example in the national payments vision, and there are many, so I'm just speaking one, is, data-driven innovation with open banking, open finance, realizing that, this has been stagnating for too long. We really need to push ahead. And in order to that, a couple of very key steps that have been taken. First of all, we're going to put the FCA in overall charge, because this sort of policy making by committee is not quite working. We need to give firms more of a one interlocutor to speak to, somebody who can really drive it forward. And, but also at the same time, asking industry to say, okay, we want to collaborate with you. We want you to, for example, in the context of a commercial model for open banking and then open finance, we want you to drive this, but we need you to do it. So I think there is I think regulators need to be receptive to the industry concerns and challenges and say, we want to innovate. These are the benefits of innovation. At the same time, I think industry, when we talk about the payment industry, I think we already touched on, it's extremely diverse in terms of the forms of money, diverse in terms of the role, a very long value chain, very different perspectives, huge companies, small companies. There is an effort from the industry as well to have a more of a shared voice, to come to agreement how to take these things forward and talk to the regulator, not in one voice, but at least in a more collaborative manner amongst themselves as well. So to help the regulator support innovation. Those are my initial remarks, and I'm sure we can dig deeper in many, many other areas.
So that's really helpful, Val. Let me just give 3 quick bullets here as to major things. I think regulators and government should focus on, and actually at the moment in the UK, very helpfully, I think they are focusing on it, because as Val says, this thing we've just had launched in the UK, I realise audiences from around the world, but it's called the National Payments Vision, and it came out alongside something in the UK we call the Mansion House speeches, where the Chancellor and the Governor both make the Governor of Bank of England, that is, both make sort of major speeches about regulation and policy going forward. I think there's a lot of encouragement in there. So the 3 points, without further ado, are as follows. 1, not just in financial services and payments, the new government in the UK is very heavily focused on economic growth. It's obviously really easy to agree with that as an admirable objective. But I think specifically the Mansion House speech put some things on the agenda about what the payments industry can do to support economic growth. And as a first point, I think that is really helpful, and it's absolutely the right thing to be doing. The second point, which is linked to that, I think is really interesting, because it's something that had gnawed away at me ever since the financial crisis, sort of finished in 2011. Obviously, when you get something as grave as the financial crisis was, rightly, the regulatory and public sector response needs to be very significant. But what the Chancellor, Rachel Reeves, said in the Mansion House speech a month ago is that in the decade that followed the financial crisis, regulators perhaps became too cautious, and that had been a brake on innovation and growth. And I think what she signalled by saying that is the post-financial crisis decade, or my interpretation of what she signalled by saying that, was that the post-financial crisis decade had finished, and we were now in a new focus that was going to be much more about economic growth. And if regulators had, in any areas, overcorrected following the financial crisis, it's time to fix that. So I thought that was a really important observation. And my third point, which is perhaps just a replay of something Val said, but I think it's worth coming back to, is sort of what I call industry input and commercial focus. The industry in the UK reacted positively to the National Payments Vision, I think because they felt that they would have more of a voice in the strategy going forward than had been the case over the last 10 years. So industry input, I think, is key. And as Val said, a focus on commercial incentives, I think, is really key as well. If you want the private sector to do something, giving them a commercial and economic incentive to do so, in my opinion, is the most effective way. So I'll stop there, but those are my big 3 themes.
That's great. One of the things that I would like to highlight from what Val said is that there is a focus on innovation, not for merely growth, but innovation for empowering consumers and giving consumers more choices. And I think that's a very key point, because what we are seeing, in fact, about several payment system challenges right now is the lack of use case in some cases. In some countries, I mean, we have debated in the retail CBDC or broadcast that in several countries that they have already rolled out the retail CBDC, the adoption is low and slow. So perhaps the use case is not there. So perhaps in that case, it's not innovation for growth, but it's innovation for central banking purposes. But perhaps there is the lack of empowering consumers and give them good choices, better choices for them. And I think that the second thing that I would like highlight from the Val's answer, and also we're going to get to what, something that Matthew also mentioned, is the cost of inaction for central banks and regulators. And we can see that very clearly because I think that it's rather evident that many central banks are either providing services, perhaps the best example is PIX or Central Bank of India, for instance, in retail payments, or galvanizing the private sector efforts. So either, as Matthew said, giving commercial incentives or regulatory incentives, or trying to get people on the same table to discuss the thing that perhaps would not be discussed or agreed on endogenously. So I think that's a very important thing to get out of both of your questions. And once again, going to something that Val said about consumers, is consumer protection. And next question is related to that, and this question is for Matthew. Regarding fraud, cybersecurity, operational resilience, in this area of rapid innovation, which is retail payments, how should central banks and regulators and payment operators adapt their strategies to address these emerging risks? Because all innovation comes with risks. What is the role of these agents in these topics, Matthew?
Yeah, so there's a lot to unpack there, actually, Carlos, in one question. But let me sort of introduce a few themes, and then I'm sure others can draw on it. So the first things, I think you mentioned fraud, cybersecurity, and consumer protection, all sort of essential objectives. They are often, sort of linked in people's minds, as the premise of your question, Carlos, demonstrates. But actually, when you get below the surface, I think the answers are actually quite distinct. So let me say a quick word, on each one, and then others can build. So I'll start with cybersecurity. Actually, this is where I think I'm not a CTO or a technologist, so I'll keep my answers business focused. But I think it comes back to something I said earlier, that a fundamental point, about payment systems is it's got to be robust, resilient, and trustworthy. Data integrity has got to be there. So obviously, those who operate financial market infrastructures absolutely have to invest in world-class cybersecurity defenses. They have to stay up to date, and international regulation is geared up to that. The international principles for financial market infrastructures contain a very strong focus on cybersecurity and resilience, and rightly, infrastructures are regulated on that. I think to move on to your other 2 points, fraud and consumer protection, let me take those in reverse order as well. So consumer protection, I think this is a really, really important point. In the UK, as part of the competition agenda, we've got this strategic objective that I agree with, where the regulators want account-to-account payments to be able to compete for retail transactions with more established channels like card payments. The review that was the precursor to the national payments vision in the UK made that point very clearly. This was called the His Majesty's Treasury Future of Payments Review, and it was chaired by an ex-bank CEO called Joe Garner. It's often known as the Garner Review. And Garner made this point that account-to-account payments was a really important part of competition for retail transactions. But this is where your point, Carlos, on consumer protection really becomes relevant, because if I buy a flight and the airline goes bust, if I pay by bank transfer, the payments industry doesn't give me any sort of ability to claim back the cost or anything like that at all. But the credit card industry, because of various history and regulatory matters, does. A point Garner made, and a point I strongly agree with, is we can only make interbank payments a mainstream route for retail transactions when an appropriate consumer protection framework is developed. I choose my wording very carefully there. Appropriate. It doesn't have to be the same as cards, but it can't be nothing. And this is where I'd come back to that point about commercial incentives. Any consumer protection framework effectively works like an insurance policy model. And that means someone has to operate the policy, someone has to operate the business model, and someone has to pay the premiums. So I think it is really essential that consumer protection is approached from the perspective of working out a coherent business model that's driven by commercial incentives. That's my line on consumer protection. On fraud, where I know you're very interested, Carlos, and I'm mindful I've talked for a long time, so I'll keep this quick. I think there are two key parts to fraud. One is refunding people when things go wrong, and regulators are very focused on that. Two is, can we prevent frauds by using the power of big data and analytics? Again, I'll give Ben and Val a chance to follow up. But again, I would very strongly advocate commercial incentives and a competitive market in fraud analytics as the best way to take that market forward. Now in the UK, the areas of both consumer protection and fraud analytics are still developing. So I think it is really important that the whole industry focuses on sustainable commercial models and commercial incentives to drive competition, innovation and growth. So sorry, that was a long answer, but there were three really interesting themes. But let me give others a chance to follow up.
I'll jump in, and Carlos, I'll mention the fourth one you mentioned, operational resilience, and then we've got a full set. And so one of the other things I look at, as well as payments and digital assets, is third-party risk management and critical third parties, not only to the payment industry but financial services more broadly. And one of the major regulatory themes in the last 5 or so years is operational resilience. Making sure that the financial industry is resilient to shocks, disruption, effectively managing the risks posed by their third-party relationships. And there's been a wave of new regulation in the UK and EU putting new requirements on financial services firms to manage those risks. But one of the interesting things that stand out for me at the moment is the regulators recognise firms alone can't manage all of them risks themselves. And so in the UK and the EU, there are new frameworks coming through to actually oversee directly some of the most critical providers to the financial services industry. And if we look ahead to next year, that's when we expect to see some of the first critical third parties designated by the regulators and become subject to that direct oversight. So I think there's an interesting angle there where regulators are recognizing, the financial services and payments industry can't manage all of these risks themselves, and there is a role there for a bit more oversight directly by the regulators.
I think that's a very important point, Ben, and I think it allows me also to extend it perhaps slightly to the question of regulatory perimeter, which I think is becoming increasingly important when it comes to payments, both in terms of payments initiation, but also in terms of fraud initiation. I think, Matthew, when you talk about fraud into two parts, reimbursing when things go wrong and preventing things going wrong. And I think a debate definitely in the UK, definitely in the EU, but also globally is if the fraud originates outside the financial services, if this fraud sort of initiates on a large digital platform, what is the responsibility of the digital platform of preventing it? And where does the regulatory perimeter need to stretch to? But also on the other side, definitely, again, both in the EU and the UK, which are the sort of jurisdiction that I'm most familiar with, but I suspect it's something also more global, is, for example, digital wallets. At the moment in the UK, most of the wallets that don't hold any sort of amount of money, so the sort of pass-through digital, are not within the perimeter. They are not considered a regulated activity. Should they be, when actually we've seen in that, the adoption is growing exponentially, and to the degree that, for example, it may cause some degree of operational disruption should they stop working, or should these firms, choose to make changes to it, but also in terms of competition, So I think the regulatory perimeter is another really big theme, and a discussion to be had about where do we draw the line, and also the power regulator of stretching that line if they see a risk emerging.
Yeah. Can I come back in on that point? Because I think Val, your reference to regulatory perimeter helps me come back to something I mentioned earlier in the call, tokenized deposits. I think actually you've literally made me realize on this call in real time why I'm so interested in tokenized deposits. I hadn't quite sort of realized this myself before, so I'll run the risk of kind of replaying you all a thought in real time, which is possibly a bit of a high risk strategy. But of course, one of the key difference between tokenized deposits and the sort of instruments in wallets you talked about, Val, it's exactly this, the regulatory perimeter. And tokenized deposits, because they are bank deposits, they are subject to the prudential regulation that underpins the activities of banks, and therefore holders of tokenized deposits are protected by financial services. It's called the Financial Services Compensation Scheme in the UK, and broadly other deposit protection schemes worldwide. So I think one of the reasons why tokenized deposits are so interesting is it sort of changes the regulatory perimeter question again. And I think from that flows an even broader concept. And this comes back to something that the Governor of the Bank of England said in this speech in Washington that I talked about earlier. Excuse me. And I think it's about the difference between business instruments and tech. His comment was in the context of retail CBDCs versus other solutions. And what he said was, in the case of retail transactions, there is no policy argument for shifting the balance towards or away from central bank money. So his point was, if we make retail transactions today using commercial bank money, there is no good, excuse me, coughing at the wrong time. There's no good economic reason why that should change. And I think one of the reasons why tokenized deposits appeals to me is if we make transactions today perfectly effective economically using our bank balances, just because new tech has emerged doesn't mean it's wrong to use our bank balances. So if tokenized deposits are a way that we can use instruments that work very well from a business perspective on the most up-to-date technology, I think that's a really interesting concept.
Great, and I think that I will chip in with something that I've also realized long ago, not today in real time as you did, Matthew, but this regulatory like boundaries or differences is really striking when you try to compare, for instance, stable coins and e-money providers. Because at the end, e-money provider is something which is normally not in a DLT or a blockchain, but is backed by deposits in commercial banks. What is a stable coin? It's exactly the same, but the backing is different. I mean, they back it in, according to attestations, to a little bit of cash, a little bit of sovereign securities, and some very safe assets. And normally it's on a blockchain. So what is the difference at the end? And the regulation there is regulation for e-money providers, but right now we don't have strict regulation or usual regulation for stable coins. So it's very similar to what you're saying, Matthew, I think. And something that I would like to highlight also about what you said, Matthew, is that refund, the ability of payment system providers or banks of recovering the money in account-to-account payments or retail fast payments, for instance, it's a key. Because, I mean, it's very nice to be able to pinpoint who was the one who stole your money with a scam or a fraud, but it's for the client. I mean, the real consumer protection is being able to make a deep research and being able to determine that there was a scam and that this guy did it, but also to recover the money. If you're not recovering the money, you're not doing anything at all. So that's a big part, and that's something that at FNA we share in our, let's say, in our suggestions or proposals to the industry about how to combat fraud. It's not only about identifying or detecting who is going to do the next scam, but also being able to recover, because no fraud prevention tool is perfect at the end. And just to highlight something that Ben also mentioned is the operational resilience. And I think that it makes sense. And in Europe, we also have the DORA with the Digital Operational Resilience Act that is highlighting how important is the technology providers, I mean, the IT providers, to the good functioning, safe and efficient functioning of the payment system and the financial system at the end. So that's also a pain point for any payment system. Good. So I think that we can go, and I just mentioned, or Matthew is the one who mentioned it first, about real-time payments or account-to-account payments. And the thing is that these, if we call them real-time or fast or immediate payments, are not new. That's something that existed a long time ago in the same books of the same bank. But the problem is now that they're becoming interoperable, and real-time interoperable payments, either in the form of retail CBDCs or fast payments, account-to-account payments, are becoming prevalent worldwide. Matthew, what lessons can emerging markets learn from UK's faster payment system regarding efficiency, safe functioning, fraud?
Yeah, sure. So faster payments obviously went live in 2008, which I remember very well because I had to make a speech at the 10-year anniversary party when I joined Pay.UK in 2018. So I will never forget that faster payments went live in 2008. At the time, as you say, Carlos, it was a world-leading innovation. But the premise of your question I might change a bit because, of course, I think many emerging markets already have learned a lot from financial payments because they've now, from faster payments, because they've now, built their own solutions on, the very latest technology. But I will nevertheless talk about a few themes that have emerged since. And of course, the first thing to say is this is very relevant in the national payments vision, where one of the most prominent areas that the committee that the government have set up to advance the strategy in the UK is actually going to look at the next generation of faster payments and how to take it forward from here. So, what we've learned from the last 18 years operating faster payments is very, very relevant in this national payments vision that Val mentioned on this webinar. So a couple of points that I'll start off with, and then I'll hand over to others. And I think these points have already come up. One is that a real-time system as a P2P transfer system is great. That's opened up all sorts of new use cases in the UK that we didn't have before. But going back to the comment I made about consumer protection and business models underlying it, P2P instant payment systems are not automatically suitable for retail transactions. So one of the most clear things I would advocate is, rather than having to do that as a phase 2, if any country is looking at a real-time payment system today, make an early strategic decision on whether you want it to be suitable for the sorts of use cases that cards are currently used for. And if you do want it to do that, then make sure that there are commercial incentives for those consumer protection models to be built. I think that would be point one. I think point two, which again we've talked about, Carlos, but it's worth recapping in this context, is that there was no such thing as authorised push payment fraud in the UK before faster payments went live. And criminals, very sadly, as criminals often do, exploited the system, and this whole new fraud business model called authorised push payment fraud, because payments could just go instantly and then the money was gone and there was no recourse. This all evolved. So I think another really key point here is that, it sounds almost funny to say it, but I have to say it because it's true. Criminals are excellent innovators. That is not me praising criminals. I'm just stating a fact that they're actually really good at targeting, specific vulnerable clients, and they're really good at innovation. Sadly, this is true. That's not going to change. So if anyone's looking to build, a new payment system, or a new specifically instant payment system, try and think about what use cases criminals might exploit and build appropriate defences. The final one, which has been a big issue in the UK, and again, I think the NPV will look at closely, is what is the approach to competition and innovation in the development of that payment system. Another reason we have the national payment vision in the UK is we also had this new regulator in the UK after the financial crisis called the Payment Systems Regulator. And some of the competitive innovations that they look to put in place after the financial crisis are now having to be reviewed as part of the national payments vision. So again, my advice to other countries would be look at the details of those competition initiatives, look at what worked, and plenty did. Look at what worked less well and what the lessons learned are, and factor that in going forward. But I think in financial services, particularly in an economy like the UK, where we've got a small number of quite large banks, the specific approach on competition and innovation is really important. And I know we're getting pushed for time, so I will stop there.
That's great. Anyone?
I mean, I would just reiterate the commercial incentives, the Matthew. I think because the faster payment system, because in the UK was, it's been in place for a long time, and it's not designed to do account-to-account payments, like to pay merchants and things. It's a peer-to-peer sort of network. I think some of the commercial incentives are missing, or at least need to be thought through right now. And I think that is lowering the incentive to invest for some of the incumbents. So I think that's a big slowing to innovation. That is not a regulatory sort of barrier per se. In fact, if anything, the regulators need to intervene to create those incentives at this stage. And I think the other thing to think about, and I think again something the UK is thinking about, is there's a lot of initiative happening all at the same time. We have central expenditure currencies, we have faster payments, account-to-account payments, we have open banking, open finance, blockchain, stable coins. You also need to think, step back and say, okay, as a policymaker, as a regulator, obviously the market will have its own trends, initiatives, and incentives, but what do I want to prioritize? How do I sequence these things? I cannot ask the market to invest the same amount of attention and money and capacity in all of these things at the same time. And so the answer will vary depending on, where you are at the moment, emerging economy, established economy, payment systems that already have instant payment, faster payments or not. But you need to think about the whole and think about, okay, what am I actually asking the industry to do? And is it proportionate and reasonable?
That's a great point, Val. Thank you. Also, Matthew. There is a very obvious step regarding account-to-account payments or fast or real-time payments, which is interoperability across borders. And I know that Ben has some background or has a lot of background on digital assets and some other ways of allowing these cross-border payments to work more efficiently than perhaps the system that we have right now with the correspondent bank system. So Ben, what role can digital assets and regulators play in achieving this cross-border retail payments interoperability?
Yeah, happy to take a first pass, and then Matthew, Val, please do chip in. I think so. To split that into two parts, you've got what role can digital assets play, and then what's the role of the regulators? And I think for both of those questions, I think using stable coins is quite a helpful example to touch on. So I think if we look at stable coins today, and in particular here talking about those backed and pegged to fiat currencies, and today they're mainly used to buy and sell digital assets like Bitcoin and others, so mainly used for investment purposes. But there is some evidence and data which is starting to point towards payment use cases emerging, and especially in emerging market countries for the likes of cross-border payments and remittances. So where, like you point out, the correspondent banking system and the cross-border payments today can be quite slow and expensive, and there are some green shoots in terms of can stable coins solve those problems. So I think that's an interesting area to keep an eye out for. And what role can the regulators or regulation play there? And I think here I'd go back to the key theme that was raised at the beginning. It's all around trust and putting detailed rules in place so that ultimately consumers and the financial services industry can have the trust and confidence to experiment with stable coins. And I suppose there's two pieces of the puzzle which I think are important. I think one, when you look across jurisdictions globally, local countries or the likes of the EU at the supranational level having harmonized regulatory frameworks in place for the likes of stablecoin issuers for the wallet providers and some of those other market intermediaries. That's important in setting, capital requirements, in setting key disclosure documents. What are the consumer protections you need to have in place? So having those in place locally, based on and really drawing on those standards set at the international level by the likes of the Financial Stability Board and some of the other standard setters, that's really important in putting the minimum regulatory requirements in place and making sure there's a degree of harmonization in terms of the outcomes those regimes will reach. But the second piece of the puzzle, which I think is important, if you want to use stable coins for cross-border payments and to solve some of those issues, then I think ensuring that those local frameworks can answer that question of, well, can we use a stable coin issued in another part of the world for payments in my local jurisdiction, or for cross-border payments from one country to another. And if I sit here today and I look at the EU through the markets in crypto assets regulation, of course it's one of the most advanced stablecoin and broader crypto frameworks globally, but in my view, it doesn't really address fully that question of, can stablecoins issued in other parts of the world be used for payments involving people in the EU? And so if I think looking ahead, and similarly in the UK, when the regulators here flesh out the detail of the framework next year, I think looking at that question, which isn't easy, I don't think we have the answers today, but really trying to address that will be important to opening up stable coins for cross-border payments.
Thank you, Ben. I think that we're running a little bit out of time, so I'm going to skip the next question, which was related to fraud and scams, but we already addressed that, so I think that we did it already. And I'm going to go to the last one, and for people who attend regularly the CBDC broadcast or the payment system broadcast, normally the last question is about having a crystal ball, each one of you, and telling us, what do you expect from the future? I mean, looking ahead, we have different alternatives of, once again, money, trust, schemes, payment instruments, and technologies. How do you see the different options of this entangled square of these four items or four concepts? Where is this taking us in the near future? What do you see? Who wants to start?
I'm happy to start, Carlos, because there's 2 points I really wanted to get in here, and I'm actually looking at the Q&A on the web screen as well, and I want to try and deal with one of the points in the Q&A, because it's always good when the audience asks a question. So I think I would make 2 forward-looking points here. The first is not about the question. The second one is. The first one is something I really wanted to get in that I haven't got in yet, so I'm going to make it here as a forward-looking point, is, for me, it is all about use cases. So when looking at emerging digital asset technology, what are the use cases going to be? The most compelling digital asset use case that I've found is wholesale delivery versus payment. Just to unpack, many of our audience will know, but just to unpack it for those that don't, delivery versus payment is not a new concept, but what it means is that for financial stability reasons, certain transactions are much more robust when the payment happens at precisely the same instant as the delivery of the asset that I am paying for. So for assets that can be placed on a blockchain, such as a dematerialized share certificate or a government bond or even a property deed. There's been a pilot on this in the UK. The delivery versus payment use case is really compelling for blockchain technology, because it means the delivery of the asset on a blockchain can be inextricably linked to the making of the payment on a blockchain, and therefore they transfer at precisely the same instant, and the financial stability and protection benefits associated with that are delivered. So I think in the wholesale markets, that has the power to be really transformative. I think in terms of looking ahead, what will drive it and how will it happen? The key thing is which assets can be tokenized on blockchains and how those blockchains interoperate with payment systems. It's the transactions that crack those questions will be the ones where this benefit is delivered. The second point I wanted to make is in response to one of the questions, because the premise of the question is really interesting. I'll just read it out. It says, does the faster payment system in the UK make the digital pound or a pound-backed stablecoin redundant? And I wanted to say, sort of in my mind, absolutely no. But there's a really interesting point that flows from it. It's almost the other way round. I think the advent of tokenized deposits and digital asset transactions will mean that systems like faster payments have to change. And for me, the absolute key innovation that I'm most passionate about is if in the underlying payment infrastructure, someone can crack interoperability between a tokenized deposit or tokenized monetary asset and a traditional deposit, what's called fiat money in economic circles. The payment systems, in my opinion, that handle digital assets best will be the ones that allow seamless transition between those two types of money for end users. Because whilst me and people on this webinar might care deeply about the difference between tokenized deposits and fiat money, the vast majority of users of payment systems actually don't, and the industry just needs to make it work for them. So those are my two forward-looking points.
Great, Matthew. Thank you. Who wants to continue? Well,
Ben,
Sorry.
you want to go?
Yeah, I'll jump in. Yeah, my internet has started to go a little bit patchy, so apologies if I drop out. Please do jump in. So looking ahead, what am I looking forward to? And so Val and I in the centre here have been doing a lot of head scratching recently about our regulatory outlook for the year ahead. And if you look across stable coins, if you look across retail CBDCs, open banking account-to-account payments, just to give a couple of examples, 2025, we're expecting a bit more regulatory clarity in the UK and the EU. Now, we won't have all the answers and the full details next year, but we will start to get some more of the details and of those regulatory and policy frameworks come through. And I think that's really exciting and important, because while regulatory clarity isn't the only enabler, it is an important one in some of those decisions banks and others in the industry are making in terms of where do we want to focus efforts and investment, when do we want to launch experiments and different products, which jurisdiction to focus on. So I think that's something that I'm looking forward to in the next year.
That's great, Ben. Val.
So I'm gonna toe the line here and say that we don't know what's gonna happen in the next year. We still don't know. But what I would say is this: first of all, 2 points. One is for certain that we need to look beyond payments to understand what is going to happen to the future of money. So things about geopolitical risks, things around competition for the big tech providers, all of those forces. Now, independence, resilience will all come into both what the market incentives, what the consumer demands, and what the policy framework is going to be. So I think we just need to zoom out a little bit more to understand what the forces that are on payments and how it's going to shape that. And then I wanted to sort of give a shout out to the last publication the Bank of England did on retail central bank digital currencies, which is maybe we were going to launch it. Maybe we are not going to launch it. But just because we're not going to launch it doesn't mean that the work we're doing is not helpful to understand more about what innovation is needed, or how the market is working. And that can be in itself sort of a motivation for further innovation elsewhere, and for us to understand better how we can support it. So I think even if an innovation doesn't initially have a discrete conclusion, or some research doesn't mean that it's not the impetus for improvements or innovation elsewhere. So I think it's all interconnected, and you can't look at stablecoin on their own, CDBC on their own, faster payments on their own. It's all can inform the other, so to speak.
That's great. I think we run out of time, but this time we were 4 of us. Normally we're just 3, so I think that we can have a couple of minutes extra. So I'll have one extra question from the audience, and I'll have one from my own interest that is going to I'm going to have it as the last one, just to close everything. So one of the questions from the audience that I would like to give to you is I lost it. Sorry. Oh yeah. Should the stablecoins be regulated, and how should they be supervised? And I would add something to that question: is do you consider stablecoin arrangements as financial market infrastructures already?
So I'm happy to have a first pass at that. I think to the first part of the question, should stablecoins be regulated? I think the intermediaries underpinning stablecoins, yes. So the likes of issuers, the wallet providers, the trading platforms, and the like. So really focusing on those providing the services around stablecoins. To the second part of the question, how should they be supervised? I think here, bringing those players within, really focusing on delivering the same regulatory outcomes as are placed on different types of regulated financial services firms. So making sure stablecoin issuers, for example, are subject to prudential standards. They are subject to, they need to make key disclosures around the assets backing the token, where those assets are held, consumer protections. I think making sure they're subject to robust standards that are similar to those applying to other firms is important. And then to your final point, Carlos, around FMIs, I think one of the interesting questions which regulators are looking at is, well, if a stablecoin is used at systemic scale, then should it be subject to more stringent oversight? And the answer that the UK regulators and same in the EU have got to is yes. And so, for example, where a stablecoin is used at significant scale for retail payments, it would be in the UK be subject to oversight by the Bank of England. For now, the Bank of England last year said there's no stablecoin out there today that would meet that bar. But if we fast forward into the future world, going back to the point at the beginning, we don't know how all of this is going to evolve, and it is something to keep an eye on.
That's great, Ben. So my question is very straightforward to Matthew. Do you think that you talked a lot about credit card and account-to-account systems and how they are compete, and how they may interoperate, so on and so forth. Do you think there is a conflict of interest when credit card companies and banks are the owners of account-to-account payment systems?
So I'll actually start with a really quick addition to Ben's question, if that's okay. Ben answered much better than I can on stablecoin regulation, but I've got one snippet to add, which is that the premise of your question that you read out, Carlos, was should stablecoins be regulated as financial market infrastructures? And someone at the Bank of England said to me once, and I think this really matters, is don't confuse a settlement asset with a payment system. They are two different things. And the reason this was said is when CBDC started, all sorts of questions like consumer protection that are issues for the rules of payment systems were sort of addressed to the settlement assets. So I think Ben's absolutely right. There is clearly a threshold to regulate stable coins, but my very strong piece of advocacy is don't confuse settlement asset regulation with FMI or payment system regulation, because technically they are two different things, even though they've got some overlapping aims. To your question that you actually asked me, Carlos, the answer is a sort of very brief one, but quite complex, which is it's not a simple yes or no. In the UK, and this is true of many developed economies, we have, a series of regulators to look at these issues. It is conceivable that some conflicts can arise, but I just don't think it's as simple as saying, yes, they do or no, they don't. So in the UK, we have a financial conduct authority and a competition authority and a payment systems regulator, and they look at these issues. But I think the underlying structures really matter here. So I'm afraid it's not a simple yes or no. So sorry to finish with a bit of fence sitting.
No, that's fine. And ending everything with uncertainty, it's great, because it means that there is going to be like a second part of this movie or something like that. So that's great. That's a good way of doing it, Matthew. Thank you. That was not planned, but it worked very well. So once again, Ben, Val, Matthew, thank you very much for joining us in the payment system broadcast number 18, the future of money and payments. I hope everyone had a joyful, interesting broadcast. Thank you, everyone, and see you next time.
Thank you.
Thanks for having us.